One of the most famous investing books of all time is The Intelligent Investor. And The Intelligent Investor is an investing book that Warren Buffett attributes to his base knowledge of how he built up such an amazing net worth. And today, I'm gonna give you 10 amazing lessons from The Intelligent Investor. The first lesson is process, process, process. See, investors have to have a process to be able to follow to keep their emotions out of investing. Emotions are the biggest enemy of the investor. So making sure that you can remove those emotions by putting into place a plan and a process and a system will allow you to be successful as an investor. And so what the cool thing about The Intelligent Investor is it lays out a process of exactly when to buy, of exactly when you should consider selling, and some of the metrics that you need to be looking at. So it reads almost like a textbook, but it's something where you could take systems from this book and build out your own investing system. The second lesson is about market behavior. And what the book talks about is the more irrational the market's behavior, the more opportunity is available for the intelligent investor, because the intelligent investor talks about value investing. So when people are acting irrational, that is when you have absolute opportunity within the market, because it's buy low, sell high. But what most people do is the opposite. They buy high and sell low because they get their emotions involved and they act completely irrational. The third lesson has to do with value and price. So the future value of every single investment is of its current price. And the higher price you pay for an investment, the lower your return is going to be over time. Now, we've talked about in the past that you shouldn't buy the dip, and that has been debunked a long time ago. But if you're a value investor, you're looking for undervalued companies that are at a fair price so that you can own those companies for the long run. The fourth lesson is a major one, and it's about margin of safety. So what you want to do as an investor is make sure that you have a margin of safety when you're in an investment. So the margin of safety just has to do with never overpaying for an investment, no matter how exciting that investment can be. Because no investor can ever just completely eliminate risk. That's not something that's possible. But what the margin of safety does is help you eliminate the majority of risk that comes into play. The fifth lesson is that you are your own worst enemy. So the investor is their own worst enemy. Their emotions get involved. And once their emotions get involved, it's game over for the investor. So reminding yourself that you are your own worst enemy and that you have to stick to your system is extremely important. The next one is future projections. So in value investing, a lot of people have to figure out what the future is going to hold, and they try to figure that out by looking at the numbers. Now, this isn't perfect every time, which is why Warren Buffett added in a bunch of other factors. He looks at management, he looks at how much cash is on hand, he looks at book value. There's a number of other factors at play here, but future projections are a major factor in The Intelligent Investor. The next one is bargain. So a lot of companies that are at a bargain can increase the risk of the investment, because a lot of times there's a reason why those companies are undervalued. So you have to figure out and dig deep as to why exactly a company is undervalued and why it is a bargain, and make sure that there is not increased risk by investing in that company. Number 8 is contrarian thinking. You have to be a contrarian thinker if you're going to be a value investor, because 99% of the time you're going against the market. And Warren Buffett famously started buying up a bunch of investments during the Great Recession in 2009. The reason why, he was being a contrarian, where everybody else was selling and panicking, and he was buying because stocks were on sale. He says himself, whether it's stocks or socks, I like to buy things on sale. Number 9 is The Intelligent Investor talks about looking beyond the dividend yield, because you do not want to just focus only on the dividend yield when you're buying a stock. Now, this is something a lot of dividend investors do, and if you have a dividend plan in place and that's a major part of it, then more power to you. But if you're looking to value invest, The Intelligent Investor warns against looking at dividend yield alone. And the last one are the 2 sources of reasons why a stock is undervalued. And the first reason that Graham talks about in the book is that stocks are just neglected, or they're just not that exciting. They're boring businesses, and a lot of times boring businesses get overlooked. And then the second reason is disappointing results. So if a company has disappointing results, but it has really strong financials and is still developing really strong financials, it may be another opportunity to be a value investment. But Graham warns against both of these as well. Make sure you're looking into those before you buy the investment. Listen, I hope you guys enjoyed this video about the 10 things that I loved about The Intelligent Investor. If you have any questions, leave them down in the comments below. And don't forget to like, subscribe, hit that notification bell as well. And we will see you guys on the next video.